Hey everybody, it's Trevor again, and in today's video, we are going to be talking about the housing market. Personally, my predictions for the housing market moving forward into this new year. We're going to be talking about supply and demand, household formations, inflation, interest rates, all that stuff. And I am not an economist or somebody who does that sort of thing for a living. However, my clients come to me for advice on this information. I listen to experts, I pay attention, I do research. And this is my opinion of where we're headed into the new year. So starting off right off the bat, the main thing that is impacting us at the moment is inflation. Specifically, we're talking about the relationship between inflation and mortgage rates. Mortgage rates are a big driver of demand, and supply and demand is what drives prices in the real estate market. So in order to get to supply and demand, the demand side of things, we need to step back to mortgage rates and then step further back to what's driving those mortgage rates, which right now primarily is inflation. So this chart shows a relationship between mortgage rates, the 30-year fixed mortgage rates, and the consumer price index over the past few years, 2018 till the end of 2022. And as you can see, and this, if you go back further, this trend is also apparent. Those mortgage rates in blue are typically higher than the red line, which is the consumer price index, inflation. Mortgage rates take their lead from inflation. The reason for that is, in part, is because when somebody is investing in a mortgage, the recipient of those payments, they're not getting any more money per month from that investment than what was agreed to when that loan was created. So mortgage investments and other bonds, they have fixed returns. And when you have a fixed return, the value of your return can be decreased over time because of inflation. So say I gave you $100 and you're going to give it back to me in a year, and no interest is going to be collected on that $100. Who benefits more from that situation? It's going to be the recipient of the $100, because $100 today can buy more than $100 from a year from now. And this always happens in any period of time, but especially so in the past few months, the past 2 years, where we've had excessive inflation, much more so than we've been used to the past few decades. So you can see this relationship sort of change in that period of quantitative easing. Quantitative easing meaning the Federal Reserve was having policy in place. They were purchasing mortgage bonds to keep interest rates lower to help support the economy. In doing so, they stimulated growth, but also they have created inflation. They have contributed towards inflation. So you see there was a period of time where that red line broke above the blue line, and it continued to stay that way for a little while until the Federal Reserve realized that this isn't sustainable. They need to stop with the quantitative easing. They stopped that. And as soon as they did, you see mortgage rates start to climb higher. And they've actually climbed back over inflation numbers now. And you see there was a small dip in inflation partway through the year, and mortgage rates did go down a little bit. And then now that we're starting to see inflation decrease again, interest rates have started to decrease again, albeit not anywhere near where they were a few months ago, down compared to around 7% where they were just recently. So interest rates are driven primarily by inflation in our market right now. So then we really should be paying attention to what's going to happen with inflation. So currently the CPI is at 6% year over year. You see those numbers in yellow. They are no longer included in that year over year calculation number. How it works is you add the most recent 12 months worth of data together, and then that's your yearly year-over-year inflation number. And this is a core CPI, so it strips out food and energy, which the Federal Reserve has much less control over. So this is really what they're paying attention to when we're talking about inflation, things that the Federal Reserve has control over. You add all those together, it adds up to 5.9, but it's because of rounding, it's really 6%. So since you add up the most recent 12 months, we're starting to see lower numbers replacing older higher numbers. And I believe that that trend will continue. You look at October and November for 2022, 0.3 and 0.2%. You go back to 2021, that's 0.6 and 0.5%. So if we see this trend continue, December, January, February, not so much March, but April, May, and June, if we're getting lower numbers to replace those higher ones, then we will start to see that core CPI rate drastically go down. There's going to be more things that we talk about further into this video that explains why I think we're going to see inflation come down. But as we see those lower numbers replace the higher ones, then we will start to see inflation come down, which would be supportive of mortgage rates going down. One of the biggest factors in inflation data is shelter. Shelter is 39% of the core CPI. This specific line chart that we have here is from Apartment Lists, which creates, gathers data monthly on a continual basis. And you could see during the pandemic, we had some really weird things happen. We had from previous this flat change over time. We went negative for a little while. And then, as many of you have experienced in your personal lives or know, we went up quite a bit with rents. So year over year rents were at one point at around 18%, which is kind of crazy. That rate of change has started to moderate quite a bit. We're now seeing that come down pretty quickly. We're at about 4.6 as of November. And this is real-time data. So this is what we're experiencing moment to moment. What the CPI looks at is year-over-year change, and they take an average. So that 18% increase year over year, that is just now starting to get factored into their calculation. So you're seeing the CPI continue to go higher and higher because it's now taking that data into account. Whereas in reality, at the moment right now, the rate of change is much lower. So it's going to take time for this part of CPI to actually moderate, to come down a bit. However, as of real time, we are starting to see this take place. So it will take time. People don't have their rents change month to month. It's usually on a longer term basis, 6 months, 12 months. So really leases don't get renewed as much. They usually change more when somebody moves as opposed to when you stay. So it's going to take time for this to moderate, but we're already seeing very good signs from real-time data on the direction that we're headed. This is a very good illustration of how this is working. So real shelter costs are at the front of the roller coaster. And as many of you have been in a roller coaster, you know, even though you're kind of on the way down, the back still has to catch up with you in order for the whole thing to be moving in the same direction. So as real shelter costs are on the way down, shelter in the CPI for a while is going to continue to go up until they both move in tandem. And that is because of the lag effects that are built into the data collection and data reporting that our society uses. All segments of the CPI are lower except shelter. So we've seen prices come down across the board for food, gas, clothing, and all of these are reflected in the CPI. But shelter, which is 39%, it is on the way down. We're still seeing increases due to the lag effect. Not to say that those prices have come actually negative, but just moderating to slower increases over time, which is exactly what we're looking for in inflation data. That's what we want. Another thing to keep in mind in this discussion is the relationship between the 10-year Treasury and also 30-year fixed mortgage rates. So historically, you can see this chart goes back 35 years. This is what we expect. We expect to see about 175 to 200 basis points between the 10-year Treasury rates and 30-year fixed mortgage rates. So the 30-year fixed should be about 2% higher, a little less sometimes, than the 10-year Treasury. So say Treasury is at 3%, we really should be expecting 5% for mortgage rates. Treasury is at 4%, we should be expecting around 6% for mortgage rates. Lately, we've seen this trend decouple, and the primary reason for that is servicing value. So a lot of people in the bond market who are in charge of these institutions are deciding, hey, we don't think this inflation is going to be here forever. We think that rates are going to go down in the future. We think inflation is going to go down in the future. So the servicing value of that loan is lower. So when you get a loan and you make your payments, the company that you send your payments to doesn't actually usually own that mortgage. They only service it. So they collect a fee from the mortgage holder, and that's their payment for doing the things that need to be done on a day-to-day, week-to-week, month-to-month, year-to-year basis on that loan. They pay the escrow payments out of the loan. They send the mortgage statements. They pick up the phone when you call and you have questions. If you were late, they notify you that they're late and they put that on the credit report. All of those different things that need to get done for that loan to function, for the payments to get collected, for everything to run smoothly, the servicing company gets paid to do that. They typically purchase the servicing rights, and then they keep some of the income from that mortgage for that. So they don't really break even right away. It takes time for them to break even on their investment. So what you typically see is mortgages staying in the books for a few years. So that's really how that is designed to work. You have they have the mortgage servicing rights for a few years. Eventually they break even, and then they've made their profit in 4, 5, 6, 7, 8 or more years once you decide to pay off that loan by either moving, refinancing, or you just keep it and keep paying the whole time. So now that we're seeing these rates go up very high and kind of decouple from the value that we would expect them to have over other fixed rate maturities like the 10-year Treasury bond, that is because smart money in the bond market thinks that mortgage rates are going to come down, and the loans that people are getting now are not going to last. They think that people are going to do their best to get out of these loans, and the servicing value of those loans is non-existent. So because there is no servicing value, the interest rate has to be higher to account for that difference, to account for the shortened time that's going to be on that servicer's books. 6% loans are going to stay in the books longer than 7% loans. 5% loans are going to stay on the books longer than 6% loans. So as we see mortgage rates come down and servicing values go up, we should actually see an accelerated pace of mortgage rates going down up until the point where we get some sort of equilibrium, where the bond market feels like those mortgages are going to last a more standard expected rate of time, where this 200 basis point spread returns to normal, and we get back to that. One of the things that a lot of people have been talking about, and you might have heard, is that a recession is coming. And I am on the same page as that. And the next few slides is going to be about upcoming recession and the reasons that I think that it's very, very likely. So at the beginning of the pandemic, we saw credit card and other revolving debt go down quite a bit. We also saw personal savings spike. You see a few different spikes on this graph. And that is because of the stimulus that was given to people during the pandemic. They had the opportunity to pay off debt. They had an opportunity to increase their savings. Now, as time has progressed, you can see credit card debt has started to go up substantially, and now we are well above where we were before the pandemic, and personal savings rates have gone down quite a bit, also lower than what we were at before the pandemic. So this is really not a good sign of strength for the economy, and this is not sustainable. What this likely means is that people are trying to maintain the same lifestyles that they're accustomed to, and they're using their credit cards and their personal savings to maintain that lifestyle. And that will work up to a point, but eventually that's not sustainable and it's going to come to a stop. And that will result in a slowdown in the economy. So aside from the personal savings and credit card debt as going in a direction that suggests a recession, another thing that we need to pay attention to is the inversion of the yield curve, which is a very, at least historically speaking, reliable indicator of a recession. So what is the yield curve? The yield curve looks at the interest rates of the different maturities, the government bonds, and it compares them. So this one specifically is the 10-year US Treasury minus the 3-month Treasury. And what happens when the yield curve goes negative is the 3-month Treasury gives you a higher rate of return than the 10-year Treasury, which is kind of bizarre. Typically, in a normal financial market, in normal conditions, you would see the longer you invest your money, the more return you get for it. In this case, the shorter you're investing your money, the higher return you're getting on it. So it is something that's kind of bizarre. It's a phenomenon we see in the bond market. And typically, when we see it, we see a recession afterwards. And like you can see in this graph, the 10-year minus the 3-month, when this goes under zero, which it has here and here and here and here, in the gray shaded areas, that's a period of time where we went through a recession. And you can see all of these, it dipped below zero, and then we were in a recession. And that has been pretty reliable. It's been a perfect predictor of a recession. That doesn't mean it will be a perfect predictor in the future, but it's a very strong suggestion that we are heading towards a recession if we're not in one already. The last part of demand that we need to look at is household formations. So historically, we've been chugging along at about 1.7 million household formations a year. What is a household formation? That's when a family unit separates. So either a child moves out and starts living on their own after they've grown up and they're ready to start their own life. That also is households getting divorced, where you have two parents separating, but most of that comes from people growing up, moving out of their parents' house, starting their own household. So as you can see on this graph, we were kind of on an uptrend in the beginning of the year, and right now household formations are actually decreasing. People who have the option to wait to create a household, to move out of whatever living situation they're in and start a new household, many of them who can are choosing to wait because of all of the economic conditions that we're seeing, primarily increased housing expense, inflation, and higher interest rates for mortgages. So what really is going to result of this? All of these people who want to create households, they're still out there. They're on the sidelines. They're waiting. They are hibernating renters and buyers who are looking to get back into the market when conditions are more favorable to them. So this isn't supportive of prices in the short term, but demographics do suggest that we will eventually can go back to that 1.75 million pace. And when that does happen, that is supportive of home prices. So what about new housing supply? So housing starts completed last year was 1.5 million. And typically we have to replace about 100,000 homes due to old age every year, old age and other causes. So when you get that net number, that's 1.4 million new supply with annual household formations last year of 1.3 million. So that is actually supportive of a moderation in home prices, which we have seen towards the second half of the year. We did see prices start to come down, and we'll touch on that in a little bit. But we are not seeing the same thing we did during the Great Recession around 2006 to 2009, where home builders were just building regardless of demand. What we're seeing now is home builders slowing down as much as they can to protect the value of the homes that they are building. And that is actually kind of supportive of home prices in the future, in the long term. So as we start to see interest rates lower and people come back into the market looking to buy, looking to rent, and that home supply is not there, that is supportive of prices going up, actually. So what I would call what we've experienced the past few months would be a home price moderation, definitely not a crash. There are a lot of people suggesting that there's going to be a crash in the future, but we've seen interest rates go from the 3s to around 7%, and we still have not seen that yet. Yes, there is a lot of pain in the housing market. The volume of transactions is down quite a bit, but we have only seen a small correction for home prices nationwide. It's just unrealistic to expect a crash. I don't see any way for us to get the inventory that we need to make that happen. Foreclosures are not very high, which I'm not touching on in this video, but new construction is not at a pace where it would really go get that decoupled from demand that we would see a crash. And it's just not realistic to expect that to happen. So what do we expect for housing? What do I expect for housing? I think that we are going to see lower inflation. The Fed has been very aggressive tackling inflation. And even though we are seeing a moderation in inflation already, they're continuing to double down on their rate increases. I think we are going to see a recession-like slowdown, if not a recession. And typically in recessions, you do see interest rates go down. Incomes increasing will help affordability. This is only true as inflation starts to moderate, because we are seeing incomes go up. We are seeing a very strong labor market for the time being. We are still in a very tight inventory environment, and that is supportive of home prices increasing. Rents are still expensive and rising. That's unfortunate, but that's the case. For Florida specifically, we are in an interesting situation because of the insurance crisis that we're in. So although I do still think that home prices will go up in Florida, the high insurance costs will be a headwind to the growth of home prices that we're experiencing. And really, I think I would rather see home prices increase than this insurance costs that we're seeing, because home prices increasing, at least it can bring value into your pocket. Whereas homeowners insurance costs, it's something that's required and you have to pay for it. And when you pay for it, it's just gone. So that's unfortunate, but that will definitely be something that impacts us in the future. I think we're going to see low single-digit appreciation for most of the country, and a pickup in activity as rates come down. More people come out of that hibernation and they want to look for houses, they want to move, they want to rent, they want to buy, and we will see a pickup in demand. So in terms of mortgage rates, what do we expect? A few things to look out for. Our headwinds are going to be global quantitative tightening. So quantitative easing is when rates are lowered and central banks buy long-term investments like mortgage-backed securities, treasuries, that sort of thing. quantitative tightening, they're increasing rates and they are either choosing not to buy it or in some cases to sell longer term investments, fixed investments like bonds and mortgages and stuff like that. So quantitative tightening, lack of central bank buying, and more debt to be financed. There's a lot of debt going around these days that needs to be financed. The tailwinds is going to be lower inflation, which I do think is coming, excess retail inventory, increase in mortgage servicing value, and a likely recession in the future. And typically when we have a recession, we see interest rates go down. I think it's realistic to see interest rates moving closer to 5% towards the end of the first half of 2023. And I think a good target for the US 10-year Treasury is around 3% or lower. I'm more confident in the mortgage rates going down than the 10-year going that low, but I do still think that that is the direction that we're headed. So, do you agree with me? Do you think I'm crazy? What are your thoughts? Let me know in the comments.